All right, let's tackle a huge question for pretty much any business out there. When you spend money to land a new customer, is that an immediate expense or is it an investment you can put on your balance sheet? Believe me, the answer has a massive impact on your financials, and the accounting rules are super specific. So let's dive in and demystify this.
Okay, let's make this real. Imagine your top salesperson just closed a massive deal, and you cut them a check for a $50,000 commission. So what happens now? Does that 50 grand hit your income statement right away and maybe even wipe out your profit for the quarter? Or is it actually an investment in all that future revenue? In other words, an asset. Getting this wrong can seriously mess with your financial picture, so we're going to get it right.
So here's our game plan. We're going to start with the big picture, the fundamental question itself. Then we'll get into the core rule. Do you capitalize or expense? We'll define the single most important word in this whole standard, incremental. Then we'll look at some tricky, real-world commission plans. After that, we'll talk about how to manage this new asset, and we'll finish up with a really handy shortcut you can use.
All right, so the official rule book we're talking about is ASC 34040. You know, before this standard, things were kind of the Wild West. Companies were all doing their own thing. ASC 34040 was created to give everyone a consistent framework, to make sure the costs of winning a contract actually get recognized in the same period as the revenue they help bring in. It's all about that matching principle.
This one sentence, right here, is the heart of the entire standard. It gives us two critical tests. First, are the costs incremental? And second, do you expect to recover them? If the answer is yes to both of those questions, then you don't expense the cost. You put it on your balance sheet as an asset. And that's a really fundamental shift in thinking for a lot of people.
Now let's really dig into that core decision. Capitalize or expense? What does this choice actually mean for your books and your company's financial story?
Okay, that word I mentioned, incremental. It's everything. The official definition is actually pretty simple. An incremental cost is a cost you would not have if you hadn't won that specific contract. The easiest way to think about it is what accountants call the but-for test. Just ask yourself, but for winning this specific deal, would this cost still exist? If the answer is no, congratulations, it's incremental.
So it all boils down to this really clear two-step process. Step 1, is it incremental? We just covered that. Step 2, do you expect to get your money back? This one is usually pretty straightforward. I mean, if you signed a profitable contract, you're obviously expecting to recover the costs. If you get a solid yes on both steps, you capitalize. It's that simple.
So here's what that looks like in practice. Instead of debiting an expense account, which would immediately tank your profit, you debit a brand new asset account on your balance sheet. You might call it contract cost asset or maybe deferred commissions. The other side of the entry is just a credit to cash or commissions payable. Just like that, you've turned an upfront cost into an asset that you'll expense over time.
Okay, the theory makes sense, but let's be honest, the real world is always a little messier, right? So let's look at some practical examples to see where the lines get drawn.
This is a great breakdown. A classic sales commission? Totally incremental. And notice that even a manager's bonus can be incremental, but only if it's tied directly to this one contract. Now look at the other side. A salesperson's salary? Nope, you'd pay that anyway. And this next one is super important. Travel and legal fees you spent during negotiations are not incremental. Why? Because you would have spent that money even if the customer walked away at the last second. You spent it trying to get the deal, not because you got it.
And this really just hammers the point home. The goal here isn't to just start allocating all your general sales and marketing costs to contracts. It's a much stricter test. It's only about those direct costs that exist for one reason and one reason only, because you won that specific contract.
Of course, compensation plans are rarely simple. I mean, they're designed by HR and finance, right? So how does all this apply when things get a little more complex? Let's take a look.
So here's a great question I hear all the time. If the sales commission itself is an incremental cost, what about all the stuff that comes with it, like payroll taxes and the company's 401k match that are based on that commission?
And the answer is a big yes. Those are incremental costs too. The logic is exactly the same. If you wouldn't have paid the commission without the contract, then you also wouldn't have paid the payroll taxes or the 401k match on that specific commission. The key, again, is that direct link. A general allocation of benefits costs doesn't count, but a direct calculation on top of an incremental commission, absolutely.
Okay, now we're going to talk about a major wrinkle, something called a substantive service condition. This is basically when a commission isn't fully earned the second the contract is signed. Instead, the employee has to, stick around and actually provide some future service to get their full payout.
This table shows just what a huge difference this one little condition can make. Look at the top scenario. The salesperson gets the full 120 grand at signing. They could quit tomorrow and keep it. That's a pure cost of obtaining the contract, so you capitalize the whole thing. But now look at the bottom scenario. Half the commission depends on them staying for a year. That second $60,000 isn't a cost to get the contract, it's a cost to keep the employee. So you capitalize the first $60K, but you have to expense the second $60K as compensation over that 1-year service period. Huge difference.
So, we've done the hard part. We've identified an incremental cost and we've put it on the balance sheet as an asset. But you can't just let it sit there forever. Now we have to actually manage it. And that involves 2 key processes: amortization and impairment. Amortization is just the fancy word for how we move the assets cost from the balance sheet over to the income statement. The whole goal is to match that expense with the revenue it helped create. So, a 5-year contract? You'd probably amortize the asset over 5 years. But, and this is a crucial detail, you also have to think about expected renewals. If that 5-year contract is super likely to be renewed for another 2 years, guess what? You have to amortize the cost over the full 7 years. The other side of managing the asset is impairment testing. Think of this as a regular reality check. You have to periodically ask yourself, is the value of this asset on my books still justified by the profit I'm going to get from this contract? If the deal goes south and it's not profitable anymore, you might have to write down the value of that asset. Now, after hearing all of this, you might be thinking, wow, that is a lot of work, especially for smaller, shorter contracts. And you'd be right. The good news is the standard setters recognize this and built in a shortcut, what they call a practical expedient.
And the magic number for this shortcut is 1 year. If the period over which you'd amortize that asset is 12 months or less, you get an option.
The rule basically says you could just choose to expense the costs right when they happen. This lets companies completely bypass the whole process of capitalizing and then amortizing for all those short-term contracts. It's a huge time saver.
But, and this is a big but, this shortcut comes with rules. That 1-year limit is super strict. A 13-month contract? Sorry, no shortcut for you. You also have to be consistent. You can't just cherry-pick which contracts you use it on. You have to set a policy for a group of similar contracts and stick to it. And finally, if you do use this shortcut, you have to say so in your financial statement disclosures.
So, what's the big takeaway here? Well, ASC 34040 gives us the framework, but applying it correctly requires a ton of judgment. Deciding what counts as a substantive service condition, or figuring out how likely a renewal is, that's not always black and white. And that leaves us with a final, really critical question. In a world where things are always changing, how do you make sure the judgments you're making today are solid enough to stand up to the scrutiny of your auditors and investors tomorrow?